All right, everybody. We are up to week 12 of Own Your Life Live. My goal today is just to help individuals become more aware of the difference between two terms. And these terms are going to be financial education and financial training. So, as usual, this information comes from books. The main book that I'm going to cover a lot of this information out of is a book called Unfair Advantage. At this point, I've been sharing some books with you. Most of them are going to be out of Robert Kiyosaki's Rich Dad Poor Dad series. I highly recommend you checking it out, as I can only touch the tip of the iceberg in a short video. So, there was a scientist out of Russia back in the 1800s. His name was Ivan Pavlov, and he was known for what was to become a term known as conditioned reflex. So there's something called Pavlov's dog training. And what he did to simplify it was he would ring a bell and then feed a pack of dogs. And he'd ring a bell and he'd feed a pack of dogs. And then after a while, he rang the bell and did not feed them. But what happened was the dogs associated that bell with it was dinner time. So every time he rang the bell, the dogs would come running, even though there was no food, and they would be salivating at the mouth. Okay, so this is an example of conditioned training, and it's something that we see every single day in our society. And I'll give you a couple examples just to clear it up. So if you remember, when Red Bull first came out, they would show somebody with low energy. And this is when energy drinks first started, and they had a tagline, and it was, Red Bull gives you wings. Most people know the answer to that. One of my favorite commercial campaigns that are out is you're hungry, you're grouchy. They display somebody as a different character who's just really grouchy, and the tagline is hungry, eat a Snickers. So these are examples of conditioned reflex. We know what the answer is. It's just well known. So the financial industry does the exact same thing. I'm going to go through a list here, and let's see if you know the answers and fill in the blanks. Go to school, get good grades, and get a blank. Next one, work blank. Next, save your blank. Next, buy a house because your house is your greatest blank. Next, live blank your means. And then we could go on and on and on. So let's see if you knew what the answers were to those. Go to school, get good grades, get a job. Work hard. Save your money. Buy a house because your house is your greatest asset. Live below your means. If you knew the answers to these, and there's a much, much bigger list than that out of Unfair Advantage, but that was the tip of the iceberg. And if you know the answers to that, then the financial industry has successfully conditioned reflexed most of us, because most of us knew the answer to that. So what I'm getting at here is what people think about money. The average person knowing the answers to those blanks, even though they're not financially educated, just shows that we've been financially trained. For example, when somebody's paycheck comes, even if the market is going down, we are financially trained, or a big part of us are financially trained to still give money to a stranger to invest for us into something that's going down. That's not financial education. That is financial training. That is a bell ringing and us salivating at the mouth even though there's no food. Now, based on where the market is at when you watch this video, you could debate that when it's on the up. Fine, fair enough. But the market doesn't always go up. And when somebody's only strategy for their future retirement is based on something they don't have control of, and continuing to put money into it when it's on the down, that's just not financial education. That is financial training, is the point I'm making here. So what I recommend is that we open some of these books I'm displaying to you. Get a little financial education. Understand at least the tip of the iceberg of what's going on out there, so that when you see what's going on as far as conditioned reflex, you can be more aware of it and make a conscious decision of whether that's the direction you want to put your money towards or not. Successful people, wealthy people, no more than just the conditioned training that we've been brought up in. And I suggest you do the same. All right, so let's bust a myth that we've been financially trained to think, and that is save your money. Now, I got to start right away by saying there is an exception to this rule, and that is everybody should have 4 to 6 months savings at all times. Anything above that needs to be invested and should not be sitting in the savings account. And there's multiple reasons. The biggest one is going to be inflation mixed with the value of the dollar going down. So let's think about this. If you have your money sitting in a savings account, let's say it's the greatest savings account in the United States, and you're getting a 1% return on your money, which doesn't exist in the United States, but let's say it did. The cost of goods mixed with the value of the dollar going down exceeds 1%. Therefore, if the dollar is going down and the cost of goods are going up at a faster rate than 1%, you are literally losing money by it just sitting there. Again, that's not financial education. A great example that anybody can comprehend is most of us know who Babe Ruth is. If they continued to print Babe Ruth cards and printed 2 billion new Babe Ruth cards per year, what would happen to the value of it? Obviously, it would go down. And that is exactly what's happening with the United States dollar. They keep printing more, therefore the dollar keeps going down. Very, very simple to understand. Myth number 2, debt is bad. Something else we've been financially trained to think. And I want to clear that up and say no, debt is not bad. Bad debt is bad. A bad debt is debt used to buy a liability. Using debt to buy something that takes money out of your pocket doesn't make any sense. So a good example of this would be a buddy that goes and gets a promotion at work, gets an increase in money. So he immediately goes out and finances a couple of ATVs or a boat, and he's making monthly payments on those. He used how far he got ahead financially and immediately put it into bad debt. Therefore, he didn't get ahead at all in many cases, farther back. Plus, if he lost that job, now he's stuck with more liabilities, not assets. So bad debt is absolutely bad. Good debt is good. Good debt is debt that puts money in your pocket. We've all heard of some mega successful person out there who's worth millions of dollars, and then later you also hear how much debt that person actually has. And you wonder, how is it that he can have $100 million net worth and be $80 million in debt? Just as an example. And the reason is because his debt is good debt. So I'm going to use real estate as an example here on why debt is a tool that the wealthy and financially free use. So we're going to use real estate as an example here. So here's the mindset that debt is bad. You hear a lot of people, they're really proud, I got no debt, yada, 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 yada. Okay, so let's say you had $200,000 and you're looking to get into real estate investing, but you don't want debt because debt's bad. That's what we're financially trained to believe. Well, with that $200,000, let's say you bought a property, cash, no debt. It's a rental property. You're going to cash flow $1,500 a month off that. Okay, to figure out your ROI, to figure out your return on investment, you simply take your monthly cash flow divided by the amount of money you have in the investment. In this case, without debt, your return on investment is going to be 9%. At 9%, it's going to take you 111 months till infinite return. Infinite return is the ultimate goal of a true investor. An infinite return is I have all my principal back and the investment is still bringing in money. If you no longer have money into an investment and you're still making profit, Technically, you have an infinite return. You cannot divide the two numbers. It's infinite. The same individual, let's say the market goes up. They can't wait for their capital gains and the market to go up. Let's say it goes up $100,000. Well, the average person, we've been financially trained to sell that house. So you bought it at 200, it goes up 100,000. You're financially trained, sell the house. So you sell it for $100,000 profit. Of course, you're going to have taxes on the capital gains. This is not exact. We're just going to call it 15%. So after selling the house, you made an $85,000 profit after taxes. But here's the problem with that. You killed your asset. You no longer collect cash flow, and you settled for $85,000 after tax. This is somebody with the mindset that debt is bad. Let's go to someone with the mindset that debt is good and use the exact same amount of money. Sorry. With debt, the same $200,000. Typically, for an investment property, a bank will ask for 20% down. So with the same $200,000, 20%, they're going to require $40,000 for one house. $40,000 can get you 5 houses for the same principal of $200,000. So we're talking the exact same amount of money here, one with debt. You now have 5 properties. And yes, you have debt, you're going to have mortgage payments. So let's just say instead of $1,500 on the one house in cash flow, let's say they cash flow $750 per house. Instead of $1,500 a month coming in cash flow, you would now have $3,750 on the same $200,000. Because of debt, you're able to get more with a higher return. The return on investment, instead of 9%, would be 22.5% instead of 9% because you used the leverage of debt. It would be 53 months until infinite return. So let me ask you, if you were to put $200,000 into something, do you want to wait 10 years, which is 111 months before your principal is back? Or would you rather wait 53 months before your principal is back? Very, very important here. Instead of selling the house, why would you kill the golden goose? There is a rule. It's don't kill the golden goose. The golden goose is your asset that pumps out golden eggs, aka residual income. Same exact situation, except for you have 5. And let's say, due to the market increasing and appreciation, each house goes up $100,000. Well, now you have 5. So you're going to have an increase of $500,000. You don't sell the house. That would be killing the golden goose. Instead, what you would do, financially educated person, would refinance the house. They would take more debt against that house. When you refinance, they're not going to give you the whole $100,000. Typically, you're looking at 80%. So you're making 80% of $500,000 because you didn't sell the house. It's a non-taxable transaction. This is 80% of $500,000 is $400,000 tax-free money. Now, I am not a professional CPA. You do have to go and get legal advice if you're going to look at a strategy like this. But you're talking putting $400,000 in your pocket, tax-free, in comparison to the $85,000 from the person that was against debt. You also keep the cash flow. You keep the golden goose and put $400,000 in your pocket. This is why financial education is so important. You use the same amount of money for a huge difference of return, plus on top of that, kept the tax benefits, plus on top of that, kept your golden goose, aka your asset, aka your residual income. When you start using debt to acquire more assets, gain tax benefits and tax-free income, you use that money and do it again. Ladies and gentlemen, this is why the rich get richer and the poor get poorer. They use debt as leverage. They understand the tax laws and use those to their advantage. And they recycle the money. This is called the velocity of money. Wealthy people's money is moving very quickly. They don't wait 111 months for a small return, kill a golden goose, and have less of a return after taxes. They understand these basic principles, and the velocity of their money is going very, very quickly. This is why financial education is so important, guys. So I just absolutely love the last line of that quote, which was, "It is more important to grow your spirit than cut your dreams." We're getting towards the end of the financial education and the mindset of Own Your Life Live, and I just want to encourage all of you to raise your bar in your life. I went to a seminar the other night. It was a little class on marketing, and one of the first questions was, do you know how much money is considered the top 1% in the United States? And take a second, think about that. What do you think is the top 1% financially in the United States? What amount of money do you have to make above to be considered the top 1%? The answer to that is $350,000. In this seminar, I said, that's it? I was thinking a couple $1,000,000 at least. The man that was teaching it looked at me and said, "What did you say?" I said, "That's it?" He said, "You're the first person that has ever come in here and said that's it to the answer." That right there told me where we are programmed, where we are financially trained to believe we're capable of. I remember when $100,000 seemed like a lot of money, or when you hear the top 1% and then finding out that it's 350. How you perceive the answer is 350 is a really good indication of where your financial limits are. And then where you're at in your life is going to be a good indicator of where your mindset limits are. The idea of Own Your Life Live was to raise that. I want to encourage everyone out there to use these principles, apply these principles to grow. If it's not about money, fine, but grow in whatever area of your life is the most important to you and raise that bar. So I've got a list of books here. Some of them are money, some of them are going to be mindset, and I want to share them with you. Again, a lot of this information was out of books. This is from going to classes. It's from going to seminars. Get out there. There's free seminars every weekend in the major city that you live in or are close to. There's books out there that cost you $10 or $15 that can absolutely change the outcome of your life. Invest a couple dollars in yourself so that you can start building that life that you want. Remember, it is more important to grow your spirit than to cut your dreams. And I encourage everybody watching this to go for it. Go for whatever it is in your life that makes you strive for more. And if you don't have that, then you need it. Get out there. Own your life. Here's a list of books. I've had a lot of private messages on books that I recommend. Now I'm going to give you a handful of them, and I recommend them in this sequence. There's so many good books out there. This is just my personal list of books that I would recommend to start with. But if you have other ones, you go to Barnes & Noble and you find some other ones that pique your interest, grab it. Grab it off the shelf. So I'm going to start right here. I think this is the most important book when it comes to financial education ever written. Rich Dad, Poor Dad, Robert Kiyosaki. If you haven't read this, if you were to only read one, I would highly recommend Rich Dad, Poor Dad. Book number 2, Secrets of the Millionaire Mind, T. Harv Eker. Great book on mindset, a little bit of financial education. Went to a seminar of his, 2 of his seminars. Great weekend. Who Moved My Cheese by Spencer Johnson. This is a book that is about change and how life is constantly changing. It is a part of life. And if we learn how to have change skills, then we can adapt to those changes rather than fight the changes, which are inevitable regardless. Next one, The Secret, Rhonda Byrne. We had a video on the law of attraction. This is a book specifically on it. What we focus on expands. What we think about is attracted to us. Be positive, be optimistic. It is so important because the law of attraction absolutely is real. Next one, we covered some of it today. Very, very small part of it. Unfair Advantage, Robert Kiyosaki. This says it all. What schools will never teach you about money? Read this book if you want to understand and get your financial education up. And last but not least, one of my favorite books of all time, The 10X Rule by Grant Cardone. I highly suggest that you get into some books. Again, if it's not these, find some that interest you. Raise your bar and go for it. Thank you.